Federal Reserve's cautious approach to interest rate adjustments. In recent discussions, Federal Reserve officials have emphasized a cautious stance regarding future interest rate cuts. They recognize the resilience of the U.S. economy while noting a gradual easing of inflation. Recent meeting minutes highlighted the officials' consensus that if inflation steadily declines to the target rate of 2% and the economy sustains maximum employment levels, it might be wise to shift gradually towards a neutral policy stance. At this month's meeting, members of the Fed's Open Markets Committee unanimously decided to lower the benchmark policy rate to a range of 4.5 to 4.75%. This adjustment marks a strategic move, signaling a smaller cut compared to the 50 basis points reduction made in September, which brought the rate down to the 4.75 to 5% range from previously higher levels maintained since July of last year. During their November discussions, officials noted positive developments regarding inflation, which has been progressing toward the committee's target while the economy continues to grow at a steady pace. Though there was a slight rise in the unemployment rate, it remains relatively low, reflecting a resilient labor market. These insights underscore the Fed's commitment to maintaining economic strength while carefully navigating the complexities of monetary policy and inflation control. The recent rate cut is viewed as a necessary measure to support ongoing economic momentum and labor market stability, all while promoting further progress towards the Fed's inflation targets. As we dive deeper into the Federal Reserve's recent discussions, it's clear that navigating the economic landscape is no easy feat. Officials have expressed concerns over the challenges in making policy decisions. With recent economic data showing significant volatility, many members of the committee stress the importance of identifying underlying trends. This uncertainty is compounded by the unclear neutral rate of interest, making it difficult to gauge how much current interest rates are impacting economic activities. Some committee members suggested that if inflation continues to be elevated, it may be prudent to pause any further easing of the policy rate, maintaining it at a restrictive level. Conversely, a different perspective emerged. If the labor market began to weaken, or if economic activity faltered, it might be time to consider accelerating cuts to the interest rates. This demonstrates the ongoing debate among officials regarding the best course of action in an unpredictable economic climate. Interestingly, in the minutes from the meeting, Fed officials chose to steer clear of discussing the potential economic implications stemming from President-elect Donald Trump's election victory. This avoidance indicates a level of caution, as the committee aims to maintain focus on established economic indicators rather than political developments. Yet the influence of expected changes from the new administration cannot be ignored. Speculation abounds regarding how Trump's policies might reshape the economic landscape. With various opinions circulating, many officials have gauged that the continuous strength of the economy could suggest that the Fed's benchmark policy rate is already approaching neutral territory, where it neither stimulates nor restrains economic activity. Meanwhile, other voices within the Fed argue that a slowdown is on the horizon, which might indicate a need to lower borrowing costs further. The aim here is to stimulate spending and investment, vital components to sustaining economic growth in the face of potential headwinds. Looking toward the future, investors are anticipating another quarter percentage point cut at the Federal Reserve's next meeting scheduled for December 17, 18. However, the outlook has shifted. Just a month prior, the likelihood of a rate cut stood at over 80%. Now it rests just above 50%. This decrease reflects a growing hesitance among investors based on the latest assessments of economic conditions. In summary, the path forward remains uncertain as officials and investors alike weigh the implications of both domestic policies and external economic factors. The balance between fostering growth and controlling inflation is a delicate one, and the decisions made in the coming months will be crucial in shaping the future of the U.S. economy. As we look ahead to upcoming policy meetings, Paul Ashworth, the chief North America economist at Capital Economics, offers insights that could affect our expectations. He emphasizes that the minutes from recent meetings don't clarify if we should anticipate another smaller quarter-point rate cut in mid-December or if a pause is on the horizon. Ashworth suggests a cautious outlook, noting, "On balance, we still anticipate another 25 basis point cut." However, he underscores that decisions will hinge on key data. The November Employment and Consumer Price Index, CPI reports due before the meeting are poised to be pivotal. This highlights the importance of economic indicators in shaping monetary policy. In the financial markets, there has been a positive response following these developments. After the release of the meeting minutes, both the S&P 500 and the Dow Jones Industrial Average reached new record highs. The S&P rose by 34.26 points, marking its 52nd high of the year, while the Dow advanced 123.74 points, securing its third consecutive record close. This upward momentum reflects investor confidence, even in the face of concerns about potential trade tariffs from the incoming administration. The delicate balance between growth and inflation, combined with the influence of significant economic data, will be critical to watch in the coming months. The anticipation of the December meeting and the data leading up to it will play a significant role in guiding the U.S. economy's path forward. Stay tuned for more updates as this story unfolds.